Hi, everybody. This is Peter Schiff. It is Monday, April 29th, 2013. On Friday, we got the release of the first quarter GDP numbers, and they were disappointing. Wall Street was looking for about 3% GDP growth. We ended up getting 2.5%. But I think if you look beneath the surface, the picture is even bleaker because what really powered the number was a 3.2% bump in consumer spending. That was the largest in a couple of years. But where are the consumers getting the money they're spending? They're not earning it because earnings were down by more than 5%. It was a huge drop in earnings, and the savings rate for the quarter went all the way down to 2.6%. That's the lowest quarterly savings rate since the fourth quarter of 2007, when Americans still believed they had all this home equity. But I think what's really going on is that Americans are dipping into their savings, they're borrowing money, and they're spending it principally on services. A lot of this spending is on rent, utilities, maybe insurance, education, rising costs. Costs are going up. The cost of living is going up. I think that's really what's driving the increase in spending. And of course, we're ignoring the debt. If Americans are borrowing money, if they're taking out home equity loans to keep their heads above water, and we count the money they spend as part of the GDP, but we don't bother to pay attention to all the debt that they incurred in the process of spending. And of course, the government is spending all kinds of money, but look at how much money the government is also borrowing. All this government spending counts as part of the GDP, even though the government had to borrow the money in order to spend it. But of course, we're saddling ourselves with enormous obligations that are going to have to be repaid out of future GDP. The future GDP is being sacrificed so that we can indulge ourselves today, spend more money than we have so that we can have a bigger number. And of course, the only reason the number was as large as 2.5% is because the government claimed inflation was just 1.2%. 1.2%. I don't believe that for a minute. In fact, in my most recent commentary, which is up on the Europac website, if you haven't had a chance to read it, it's called Changing the Conversation. I also bring up another inflation indicator that I hadn't talked about before, and that's the Big Mac. The magazine, The Economist, does a survey in order to measure purchasing power parity among nations, and they use the price of a Big Mac to see whether they think currencies are over or undervalued based on purchasing power parity. But also what that does is it gives us a look at the prices of the Big Mac. And it turns out that from 1986 to 2002, when they first started doing this in 86, if you measure the Big Mac and you look at it compared to the CPI, during that 17-year period, both the Big Mac and the CPI were averaging about 4% a year. So they tracked one another pretty much precisely during that time period. There was a little variance, but during the entire time period, pretty much both the Big Mac and the CPI up 4%. But since 2002, there's been a major divergence. The Big Mac is up by better than 6% a year, and the government claims that the CPI is only 2.5% a year, and of course they claim it's even lower now. So who are you going to believe? A hamburger, right, that has no agenda, that is what it is, or the government that clearly does have an agenda, because something's not right. Either there's something uniquely wrong with McDonald's in that they're somehow so unproductive that the price of McDonald's burger is now rising much faster than the overall rate of inflation or price increases in the general economy, or nothing has changed about McDonald's. It's just that the way we measure inflation has changed. And in the past, the CPI was able to capture inflation as measured by a Big Mac hamburger. But today, the CPI is only capturing a fraction of the price increases as shown by the increase in a Big Mac. So I think if we had a more reliable inflation a barometer or measurement, we would have seen that the economy did indeed contract in the first quarter of 2013. And of course, I don't even think that a rising GDP is necessarily indicative of a growing economy anyway. I mean, what are you spending the money on? We spend more money on legal bills. We spend more money on health care. We spend more money building prisons. Does that necessarily mean that we're better off? We have a natural disaster. We got to spend money to clean it up. It's not necessarily a good barometer of economic health in the first place, because sometimes you want to spend less. I think the economy is better off if we spend less money on health care. It's better if we're healthier and we don't need to spend as much money going to the doctor. I mean, most families, if you told them that your medical bills are going to go up fivefold, they wouldn't be happy about it and talk about how this is so great for their personal economy because they're getting to spend more money on health care. They would just assume have their health care bill be zero because they were healthy and they didn't need to go to the doctor. But now, now that I'm talking again about GDP, these numbers were disappointing. And the government's makeover, which I just found out about recently, I guess couldn't come at a more convenient time for the government, because starting with the second quarter of 2013, and of course they're going to revise the first quarter number a couple of times before we actually get the second quarter number. But when the government gets around to delivering the news for the second quarter, the U.S. economy is going to be quite a bit larger than it was during the first quarter. Now, it's not going to be because we're actually more productive. It's because the government is going to launch a brand new methodology for computing the GDP. They're going to change the way they've been doing it all these years, and they're going to start to include a bunch of things that in the past they never included. They're going to include things that no other country includes when they calculate their GDP. And as a result of this makeover, these brand new additions, I think instantaneously the U.S. economy is going to be 3% larger. That's a big number. It's like $400 or $500 billion of GDP is going to be conjured out of thin air just based on the change in the methodology for computing GDP. This is what the government does, right? They change the way they compute statistics. Unemployment's too high? Okay, we'll calculate it another way. Now it's not as high. Inflation's too high? Wait a minute, let's find a new way to calculate the inflation rate. Oh, look, we solved the inflation problem. There's not that much inflation. Now the government wants the economy to appear bigger. Why? Well, because it makes the debt to GDP look smaller. A lot of people are talking about debt to GDP now. Well, if they can make the GDP larger by figuring out another way to calculate it, well, now they can make that ratio appear better. Also, people are talking about government spending as a share of GDP. Okay, let's make the GDP larger, and that means the government spending has now come down as a share of this larger number. But of course, this isn't the first time that the GDP has gotten a makeover. Governments do this routinely. They massage the data, the way they compile it, in order to create the false impression that the economy is performing better than it actually is. Now, what these exact changes are, I don't want to go over them on this video blog, because I already did a piece on Schiff Radio in which I went over all of the new changes, and you can watch that. It is already up on a different video. It's not on the Schiff Report, but it is on my YouTube channel, Schiff Report, which if you just subscribe to this through your Pacific Capital and you're getting those emails, you should also go to my YouTube channel, the Schiff Report, and sign up over there as well, because there's a lot of other videos that I record that are on my video blog on YouTube that don't make it into the official Schiff Report that we mail out through the brokerage firm. So go down there and sign up for that, or even if you don't sign up, watch the other video blog about the GDP. And there I go over the specific changes that the government is going to be launching starting with the second quarter of 2013. Also, when it comes to inflation, I'm actually hearing now a lot of discussion that the Federal Reserve needs to create more inflation in order to satisfy its mandates. Remember, the Federal Reserve has this dual mandate of employment and price stability. And if you read the mandate, the mandate is for price stability. is one of the keys. It also talks about maintaining moderate interest rates, I think, in there as well. But the ones that most people talk about are maximum employment consistent with price stability. Now I'm hearing a lot of talk that since inflation is only 1%, right, the way the government measures it, of course, the way we all feel it, it's a lot higher than 1%. If you actually go out and shop, you know that inflation is more than 1%. But let's accept the government's word for a moment that inflation is only 1%. According to a lot of people, some of them on the FOMC, this means the Fed is not achieving its mandate on price stability because it has a target of 2% inflation, and therefore it needs to deliberately create more inflation in order to bring the 1% inflation rate up to 2%. Now, if the real mandate is price stability, doesn't a 1% increase in prices indicate that prices are not stable, that they're rising by 1%? And so the Fed is still not meeting its mandate of price stability? Because if prices were stable, they wouldn't be rising at all. In other words, somehow the Fed has rewritten its mandate without Congress changing a word of it. Because now the Fed no longer supposedly has a mandate for stable prices. They have a mandate to make sure that prices rise by 2% a year. And if for some reason they're not rising that fast, the Fed is failing on its mandate, and it needs to make sure that it increases inflation to achieve that 2% target. So in other words, instead of stability, the Fed's mandate is increased prices. The Fed is now mandated to decrease the value of the money. By mandate, dollars must lose value. And if they're not losing at least 10% of their value every year, the Fed is under pressure to make sure that the dollar loses more of its value. Now, of course, the real inflation rate is already much higher than 2%. So really, what the new mandate is forget about what's actually happening in prices. The mandate is to make sure that the official measurements of inflation are at least 2% a year. Regardless of what inflation may actually be, all we care about is the official measurements, whether it's the CPI or something even worse like the Personal Consumption Expenditure Index that the Federal Reserve wants to talk about. But they're using all of this as an excuse to create even more inflation. And one of the reasons they like to create inflation is that they can pretend that the economy is getting bigger when all we're doing is spending more money to buy the things that we need. And in many cases, we're borrowing the money to do it. And one thing I wanted to talk about on borrowing, I actually read this article in Bloomberg. It just came out today. And the Bloomberg piece was trying to make the point that the fact that interest rates on sovereign debt are so low around the world, the fact that sovereign debt is so cheap, it's proof that governments aren't borrowing enough. That all the people who say we need austerity are wrong because the market is telling us that governments aren't borrowing enough, that there's a shortage of sovereign debt because that's why rates are so low, and that governments need to pay attention to the market and look at these market signals and see the fact that interest rates are so low and interpret that to mean we need to borrow more money. Rates are too low. There's not enough bonds. We need to increase the supply of bonds because the market is telling us that there's not enough of them. I mean, this is the most crazy, asinine logic, deliberate attempt to deceive the public. It overlooks the most important aspect of this whole deal, and that is the quantitative easing, the money printing, the debt monetization. The reason that interest rates are so low is because central banks are buying up all these bonds. They're printing all this money. Now, if central banks weren't doing that, if the Fed didn't have quantitative easing, would interest rates still be so low? Absolutely not. In fact, I would argue that the mere fact that all this quantitative easing is going on is proof in and of itself that governments are borrowing too much money right now because they can't find enough private sector demand at these low interest rates. The only reason they can get away with borrowing so much money is because the central banks are monetizing it. So, in fact, what is going on in the marketplace proves the exact opposite of the point of this article, which is that we need to borrow more money. The fact of the matter is the markets aren't working. The markets are being distorted by the central banks. They don't care how much they lose buying these low-yielding government bonds. They just create the money out of thin air. They're doing it for a political agenda. The fact of the matter is governments are borrowing too much, they're printing too much, they're spending too much, and it's all in a vain attempt to try to artificially stimulate an economy that's been overstimulated and to delay the day of reckoning. And the problem is, the longer they delay it, the more we have to reckon with. And ultimately, we're going to have to pay a huge price for the fact that we didn't deal with these problems sooner rather than later. Now, we're going to get more economic data later in the week. We're going to get the non-farms payrolls numbers. Remember, a month ago, we got the jobs report, and that was also very disappointing for those who had drunk the Kool-Aid and who believed that the economy was recovering. We had a tremendous exodus, again, out of the labor market. We're going to see what happens on Friday with the labor market. I'm going to be back again and trying to record another video blog on Friday after those numbers come out. Also, we'll be following up on what's going on with the price of gold. We've had a very substantial rise in the price of gold since gold bottomed out on the Monday following the last video blog I did over the weekend, in which we had a big drop on Friday, and I speculated that the bottom hadn't been seen, that we'd probably see the bottom and a turnaround by Tuesday or Wednesday, and we did bottom on that Monday. So far, the low for gold was on Monday. We've had a pretty big rally since then, but still maybe recovered about half or not quite half of what was lost. Of course, the mainstream media has been trying to scare everybody into selling their gold, and even though now gold is rising, they're claiming that it's a dead cat bounce. It's not going to last. Maybe there'll be a retest of the lows. I don't know. A lot of people are saying that the fact that so much buying is out there has been tremendous amount of physical buying. I can attest to that personally. My own company, Europac Precious Metals, had a record buying, a record month from our clients, and I know that that's been repeated because we have shortages and delays for all sorts of products that used to be readily available, but now there's all this demand. The media is trying to spin this into a negative by saying that, well, it's the small guy who's buying, but the professionals who know a lot more, they're the ones that are selling, and so this is a contrarian indicator. I think they got it wrong. I think the major selling in the metals market has come from the small speculator that trades on the futures market, that trades on the ETF. That's where all the selling has been, the small speculators. I don't think the larger investors have cashed in. They're probably holding on. And the real buyers, the buyers in the physical market, who are not just trying to jump on a moving train to try to catch a small move because they want to get in on something that's going up. The physical demand has been ongoing and consistent for years. But you have had some of the Johnny-come-lately hot money among smaller speculators. They've jumped on. They're the ones that have sold. They cashed out. In fact, I think you have a lot of small speculators that are now short gold, that sold into the lows and that are holding on to these positions with losses. And we'll see how long they can hold those losses as the price moves higher and we turn up the heat. I think a lot of those people that were quick to short the market are going to end up covering at much higher prices. That's it for now. Again, don't forget, check out the longer video on my video blog about all the changes to the GDP, and tune in on Friday for my recap of the jobs numbers for, I think it's going to be April's job report coming out on Friday. Take care, everybody.